Here's your host, consultant and financial planner, Adam Koch.
All right, everybody. Today I'm thrilled to introduce another guest. We've done some work in the past here in Columbus, Ohio. We've done a live event on this very topic, but this is really, really exciting stuff for me. Aside from bringing awareness to business owners on the crucial need to do planning well in advance of sale, in other words, business transition planning, 1031s and DSTs are probably one of the most, coolest. They're not so well known. And whenever I was just on a podcast for another individual in San Diego, and most people just haven't heard of this stuff. And so we're trying to get the word out. And Greg Smith, he is the Ohio, Kentucky, Kansas, and Missouri Vice President for Property Exchange Services, Inc. He was admitted to the Ohio Bar in 1996 and also admitted to the U.S. District Court for the Southern District of Ohio. He received his BA, magna cum laude from Kenyon College, and his Juris Doctor from the Ohio State University College of Law. He originally practiced real estate law with a downtown Columbus, Ohio law firm, and then was with Chicago Title before joining IPX. And he's got over 22 years at this point experience in the field of 1031 exchanges. And he's a seasoned professional. He's facilitated hundreds of successful 1031 exchanges of real estate. I'd say thousands probably. And he's done several presentations. We just did a webinar actually, and you can look at that. If you check out our YouTube page for Elevate, you'll find the webinar there if you'd like to watch that back, which was really interesting. Had a lot of visual aids, which we're not going to have today. But he's also a frequent lecturer on the topic. And like I said, this is the second event we've had. We did a live event in Columbus, Ohio a couple years ago. And it was so well received. We thought it would make a lot of sense to do it virtually through the webinar and then again on this podcast. One of Greg's big passions, just personally, has been coaching his kids' baseball, soccer, and basketball teams, all while enjoying as much travel as humanly possible with his bride, Maria, and their family. And during today's event, Greg and I both are going to get into the intricacies of 1031 exchanges, the DST, which stands for Delaware Statutory Trust. We're going to cover both basic principles as well as advanced strategies, essentially teaching you how to create tax-free income and inheritances from real estate you would otherwise have to pay taxes on. So we're sharing secrets today. If you're a seasoned investor, if you're a brand new, if you're just getting started and you're just wanting to soak in some knowledge, there's going to be something for everyone today. So enjoy my conversation today with Greg Smith. All right, what's going on, everybody? Thank you so much for joining us today. The Elevate Your Business podcast is an educational show aimed at providing business owners with honest, authentic, fiduciary-driven education to grow their companies for eventual sale and exit. This podcast is produced bi-weekly, offering straightforward advice and expert knowledge to help you navigate the complexities of business growth and transition. So be sure to subscribe on YouTube, Apple Podcasts, and Spotify. And you can also find us on the socials on X, as well as Instagram and Facebook. And the handle is @ElevateAndExit. And if you'd like to get access to more videos, articles, podcasts, screencasts, other educational resources, just head over to our website at elevateandexit.com. So enough of the housekeeping today. I'm excited to introduce our featured speaker on our podcast today. I've done some work with him in the past. Greg Smith, Vice President for Property Exchange Services, Inc., with over 22 years of experience in real estate law and 1031 exchanges. Greg is a seasoned expert and frequent lecturer. Today, we're going to teach you how to avoid paying tax on the sale of residential and commercial real estate, all while diving into the intricacies of 1031 exchanges and something called the Delaware Statutory Trust, or DST for short. Greg, as I mentioned in the intro, we did a live event a couple years ago, and it was so valuable and informative, we thought it would be a really good idea to flip the script and do this virtually instead this time, hoping to reach more people and bring more awareness to this very not so well-known strategy. So for those who missed it, we'll be posting a replay of the webinar we just did on our YouTube page, as well as across social media. So you'll be on the lookout for that. But as for podcasts, Greg, thanks for hanging out and spending the afternoon with me again.
Hey, pleasure to be here. I appreciate it. Thanks, Adam.
Yeah, for sure. Let's start with the simple stuff. I'm sure there's some people out there that are watching or listening that have heard of a 1031 exchange, but I'm willing to bet there's tons of people who don't even own real estate, but they know people who own real estate. That they might want to share this over a birthday dinner or over Thanksgiving to say, hey, I was watching this podcast or this screencast, and they were talking about 1031s, and they're talking to their uncle or something that owns real estate and maybe they teach their uncle something. So what is a 1031 and why is it beneficial for investors?
Sure. So at its most basic level, it's coming from Section 1031, the tax code, of course. And it's the idea that when you go to sell any kind of business use or investment real estate, and instead of getting hammered by all the state and federal taxes, instead you reinvest into more real estate. And it's a way to stay tax deferred. You can kick that can down the road. And like we'll talk about in a bit, you can kick it down the road indefinitely and actually make the taxes even go away. So reinvesting instead of pocketing the money means you don't have to pay the taxes. And it's an incredible tax break for real estate.
That's what I like. Making taxes go away forever.
That's right. That's right. Yeah, we call that swap till you drop in the industry. And it means anytime you sell property, you just reinvest into more, you grow your empire and grow your rents over time, but never sell anything and pay the state and federal taxes. That way, it eventually gets into your estate. Unfortunately, the drop part is going to happen to all of us someday. And when it gets into our estate, it becomes tax-free to the estate. Your heirs get a stepped up tax basis. So you leave that property to your kids. They get it at whatever it's valued at your death. And so if they turn around and sell the property, totally tax-free to them as well. So it's an absolutely beautiful thing tax-wise, even though none of us want to be in too big of a hurry to get there.
So as a quick summary, if anybody owns commercial or residential real estate, they want to sell it, they don't want to pay cap gains, all they have to do is 1031 it into another like-kind property. And as long as they follow the rules, they can defer that tax, till next time, or potentially forever if they continue 1031ing or just owning those properties until they pass.
That's right. And you mentioned that key word, like-kind property. That certainly confuses people. So like-kind meant a lot more back before the Tax Cuts and Jobs Act. You used to be able to do 1031s on just about anything. It could be aircraft, business equipment, and so on. But now it's real estate only.
You can't sell your antique knitting tool collection for lots of money in 1031.
Exactly. So you used to be able to do that. And if you wanted to reinvest into more of the same, the government said, great, no taxes are due. But they got rid of it for everything but real estate. But real estate is so friendly that you can sell any kind of business or investment real estate and go out and buy any kind of business or investment real estate. So it's perfectly okay to sell your rental property and go buy a commercial property. You could sell farmland and buy a hotel, anything for anything, other than it's not going to generally apply to your principal residence. They don't consider that business or investment. That's personal use where you live. A pure vacation home that you don't rent out at all typically also would not qualify for 1031. Just about everything else qualifies.
Yeah, I think that's crucial too, because I think that, if you have a vacation property, I think it's pretty quick misunderstanding to think that you can 1031 that over because, I barely live in it. I barely spend time in it. But if you're not renting it out, that's the key.
And vacation homes are sort of the worst case scenario because when it's your principal residence, you generally don't need 1031 because Section 121 that governs those, it says as long as you lived there 2 of the past 5 years and you haven't sold another home in the past 2 years, then you don't pay taxes unless you have more than 250,000 of gain as a single filer or more than 500,000 of gain as joint filers. So for 99% of Americans, they're never going to have those kind of gains on their residence anyway. So you're not going to pay taxes as you sell your homes. But then the vacation home versus investment property where you can use 1031, now you're just hammered on the vacation home. So we do see a lot of people stop using it as a vacation home before they sell it.
Smart.
Turn it into a rental for some period of time, then sell it and use 1031.
That makes a lot of sense. And just so the viewers and listeners understand, a second ago you were talking about not vacation property, but
principal residences.
Principal residence, yeah. Thank you. Explain the 250 and 500. So 250 for single, 500 for joint filers. Explain to them. Some people have a misconception about whether it's cumulative throughout their lifetime, like the lifetime exclusion, versus per transaction.
Right. So it is pure per transaction, excuse me. So there was something, it probably was 30 years ago now, where you got a one-time tax break or you got a one-time tax break after a certain age. That all went out the window a long, long time ago in the tax code. This is as simple as you could move into a new home, live there 2 years, sell it tax-free, move into another one, live there 2 years, do that over and over and over, and never pay any taxes unless you beat that threshold again of more than 250,000 of gain single filer or 500,000 joint filers. So yeah, there are cases where people get massive gains on their homes and pay some tax, but they're rare.
That's a question I get. I don't want to say often, but when this comes up, that's when that happens a lot, where people will say, "Well, if I do that, can I only do it once, or I did it once before, so can I still do it, or do I only get the net gain?" And obviously, it's a misconception. But speaking of misconceptions, aside from the ones that you mentioned, are there any other misunderstandings, misconceptions, pitfalls that investors should be aware of when considering a 1031?
Right. Well, one of the most depressing calls that I'll get a few times a week is when someone calls up and says, "Hey, Greg, I'm doing this deal. My sale of this investment property is going to be 200,000. My purchase is going to be 300,000. Everything looks great." And I say, "So, what stage are you at? Is your property in contract to sell? Are you putting it on the market? Where are you at?" And they say, "Oh yeah, we closed last Friday with the title company."
Oops.
And I get that all the time. And you have to give them the bad news that unfortunately, it is super important to understand the 1031 must be set up prior to the sale of your relinquished property, as they call it. So what's going to happen is you're going to call me, hopefully before that happens, you're going to say, "Hey, I've got an upcoming sale, or I'm putting my property on the market." We'll plan ahead. We'll talk to the title company that's going to be doing the sale. We're going to have them send us a copy of the contract and the title commitment. Once we review those, we draft up the 1031 exchange paperwork that the IRS requires. We get that out to you. It has to be signed before your closing goes through. And what happens, our company called a qualified intermediary, we step into your shoes as the seller. Okay, so we actually become a principal in the transaction. That gives the IRS the right to send the money to us instead of handing it to you after the closing. And then that allows you to stay tax deferred. We put that money in a bank savings account for you. From that closing date, then when you sell, you have 45 days to identify what you may want to buy, and you have 180 days to get closed on your new property. So it is a limited time span, and you do need to move quickly to do what you want to do. But the qualified intermediary has to hold that money, and we do the paperwork that keeps the IRS happy.
That's a good segue. But I mean, you kind of explained it, but I was just going to ask if you could just summarize the full process from beginning to end. Step 1, 2, 3, 4. Run through.
Sure.
It.
Yeah. So that's part of it. So, right. First step is call us anytime you have any questions, because there are occasionally confusing exchanges where it's good to take steps ahead of time. 90% of exchanges.
Right? Before
yeah. Right. If you've got a 3-member LLC and some people want to exchange, other people don't, we want to handle that sooner than the closing table when you're ready to sell. All right. That gets a little bit much. So the sooner the better, of course, to talk to a company like ours. And then again, once you get into contract to sell your property, you definitely want to talk to a qualified intermediary. They're going to line up with the title company, get the paperwork put together. You'll sign that before the sale. After the sale, the funds get wired from the title company to the QI. You've got the 45-day period. So we're going to send you the replacement property identification statement. Now, that's a strange thing. They say you have to identify what you're going to buy within 45 days. You're not required to be in contract on it. You're not required to be closed on the new property. But by day 45 after your sale, you at least need to say, "I might buy 41 South High Street, I might buy 50 Main Street, or I might buy 20 Broadway." And you write those down, you sign and date it, and you send the form to your qualified intermediary. Then once you're to day 46, and this is very strict, you can only buy those properties you identified.
Yeah.
And you don't have to buy them all, but you could buy one or more to complete your exchange. So we're going to be talking about DSTs a little bit later, the Delaware Statutory Trust. But that's one reason why DSTs are so popular, that the DSTs are a product that's sort of on the shelf ready to buy. So they're easy to identify and close on quickly. In fact, most of our DST customers, the exchangers going into DSTs are closed within a couple weeks after their sale. So they don't even do the identification process because you only have to do that if you get out to day 45. So you'll get past that 45-day period. Again, you've got another 135 days after that for 180 days total. And you must be fully closed on your new property by day 180. So at some point in that time period, they're going to call up. They're going to say, hey, Greg, we're closing with such and such title company next Friday. We're going to do the same thing we did on the front end. We'll have the title company send us the contract, the title commitment, their wire instructions. We'll do the little bit of paperwork the IRS requires on the back end. The customer will sign off to authorize the funds to be wired for the purchase, and they'll complete their 1031 exchange. And then at the end, we're going to send them a final account statement. This will have the key dates and numbers they need. The average client will hand that to their accountant if they don't do the work themselves. The accountant's going to see that. They're going to use those numbers for a Form 8824. So the IRS requires a Form 8824 with their tax return to show that the 1031 exchange has been completed. And that's kind of the end of the story.
Okay. And you already mentioned, one of a big mistake that you can make on the front end, I didn't know that you get that many calls. I mean, it kind of saddens me to hear that when you said, I get these calls, about 2, 3, and I thought you were going to say times a year. I didn't do it. No, 2, 3 times a week.
I got two yesterday as we near the end of the month here and things are busy. 2 yesterday, one where they'd closed that morning, one where they'd closed a couple days earlier. And yeah, they're just out of luck at that point, unfortunately.
Yeah, well, and it's not their fault. They just didn't know. And that's why we're doing this, right? That's why we did the webinar we did today. That's why this is going to go out on July 4th, by the way. We're trying to educate people and let them know so they don't make these mistakes. But speaking of mistakes, you mentioned the front end, what about what other pitfalls are there, throughout the process that, aside from
Sure. Yeah, so you want to plan ahead to understand how the numbers work. That's a big one where people go wrong. So they'll come in and they might be selling a property for $500,000, but there's closing costs and they're paying off a lot of mortgage debt. Maybe they're walking away with $200,000. So I would say a large percentage of customers, 40%, think they just have to reinvest the $200,000, right? That's what's coming out to them. So they think, yeah, if I don't pocket that cash, I go buy something for $200,000, I'm good. And that's not how the IRS looks at it. If you sold for $500,000, and let's say for easy numbers, you had $50,000 worth of closing costs. So that could be the big one, the real estate commission, typically title fees and so on. So now you're down to a net sales price of $450,000. That's the magic number the IRS wants you to match up. So you need to go buy $450,000 of replacement property in order to owe no state or federal taxes. And the other breakdown to look at that is they want to see two things. They want you to not keep cash. If you decide to keep $10,000, that's allowed. You'll just pay your taxes on the $10,000. But they want you to reinvest all the cash, number one, and they want you to replace any debt paid off. So if you paid off $250,000 to the bank, they want you to get a new loan on your new property of $250,000 or more. So the way to think about it, if everything matches up or goes higher from property A that you sold to property B that you bought, the IRS is happy. Nothing's changed. They sort of pretend that you didn't sell. But if you keep any cash or pay off debt that doesn't get replaced, they want you to pay your taxes on that portion of it. So people want to know those numbers going in.
Yeah, makes sense. What about DSTs then? Because we understand we understand what a 1031 is now. We understand how you avoid tax, so you can continue 1031ing into other properties, commercial, residential, real estate until you pass, at which point it steps up in basis. Let's talk about my favorite topic, the Delaware Statutory Trust, or the DST. How does that fit into the framework of 1031s? Talk about the advantages.
Sure.
How it benefits people.
People had a really smart idea a few decades back, and they said, why are we letting the big players have all the fun? The big players being the real estate investment trusts and the pension funds, the insurance companies, the people with fat stacks of money that can go out and buy a property for $100 million if they want to. Whereas the average investor that maybe sells a rental property and has maybe a few $100,000 of proceeds, maybe a couple million of proceeds, obviously they can't go out and buy giant multifamily complexes that cost $100 million or college housing for $50 million or all those types of things. So people had a bright idea. Hey, what if we bought those things, sold them off in pieces to investors? So that's the general idea behind a DST, Delaware Statutory Trust. And what's different is that the DSTs are not sold through traditional commercial real estate brokers or residential real estate brokers. They're sold as securities through financial planners. So you can meet with your financial planner. They can show you different things that are out there, as Adam well knows, and I'll say a few more things about when I'm done blabbing on. But you can find out, oh, I can defer all my taxes from my sale, take those proceeds, put them into a DST investment, and now I'm getting away from all the hassles of ownership. And I know you'll probably say more about that in a moment, so I don't want to steal all your thunder here. But you get into a hassle-free investment where a company like Inland is going to tell you, okay, we're going to own this for 7 years, then you're going to sell it. You'll have some cash-on-cash return coming to you every month. And then at the end, you're hoping you have back-end appreciation. So it's a very popular option with 1031 investors. And we're seeing more and more money go into DSTs as Adam and I do our thing and more people learn about what's going on, right? So it's a pretty neat option.
Case in point, I wanted to share a few examples today. We normally don't do this. We normally don't throw slides up here because there's a lot of people that are listening on Spotify and Apple Podcasts that can't see anything at all. So I'm going to talk you guys through it. So if you're listening, I'll talk you through it. If you're watching, obviously you can see the screen here. But I just wanted to share a couple examples of how these work. And then just kind of recap what Greg said and really how amazing these investments are and how much they can benefit you, family members you have, real estate investors, So here's one example of a DST that could be used as a 1031. So you sell your real estate, again, residential or commercial. You take the proceeds, you 1031 those proceeds into this healthcare system, so a hospital DST. You are now a fractional owner of that hospital. So you still own physical real estate. It's just non-traded real estate. It's private, but you're part owner. You don't pay any tax on the 1031 on the exchange. You don't pay tax on the sale of your real estate. And now you're going to get 3.5% per year. And this one, again, this is old. It doesn't exist anymore. There's several other options to pick from. And that's part of the discovery process when we meet with clients. We always go through, the different sectors and different types of real estate that we could purchase. But and actually, I'll mention that just real quickly here in a second. But here's one option. Second option would be come on, mouse. The second option, worry-free living. So single-family housing. I'm sure many of you have heard of these places that people are moving to downsize. They sell their house. They don't want to mow the lawn anymore. They don't want to deal with all the hassle that goes along with being a homeowner, but they don't want to live in a condo and share walls with anybody. So, this is a place called Lakewood Ranch. Again, this one's not available anymore either, but it pays 3.15% per year. And then you don't pay any tax on your real estate when you sell. You 1031 it here. And now you're a fractional owner of this community, which has, as you can see here in the picture, you've got a pool, you've got, neighbors, but you've got your own home. So that's another one. And then the third example I wanted to share is just one other sector. And I know, Greg, you said this was really, really hot. That was the word you used on the webinar we did, along with a couple other sectors like storage units. But the one we're looking at right now is student housing. So dorms, off-campus student housing. These places are, these days universities are competing for students because, they want the students, but, they go from one university to another. And then the second school they go visit, this place has a golf simulator in the lobby. And all of a sudden they're making their decision of where they're going to go to school based on how cool the pool is and the fact that they have a golf simulator to play with for free on a daily basis. But anyway, this is another example, where in this case, you'd be a fractional owner of student housing. And again, 3.25% per year. And then all of these eventually are going to sell. And when they sell, you don't sell them. Granted, you can sell your shares. There's a limited market for it, as you could probably imagine. You can't have everybody going in and selling everything they own all the time, because then the person in charge, in this case it's Inland, would have to sell the whole property to give you your money back. So they can't do that. That would be a fire sale. So you got to look at these as longer term investments, just like you look at your real estate portfolio as a long term investment. So you 1031 into one of these non-traded Delaware Statutory Trusts. You hold it for the long term. You're getting cash flow while you own it. As it appreciates in value, as we hope it's going to appreciate in value over time, eventually it sells. Once it sells, you're going to have a profit to deal with, and you will have to pay cap gains. You have to pay tax unless you do another 1031. And at that point, what we would do is simply find another DST, do another 1031. Before we do anything, we'd call Greg so we don't screw it up. And then we don't pay the IRS thing we don't want to own. And from there, it's just a matter of looking through a menu and deciding what kind of thing we want to buy. And I promised I would show up a quick list here. I'm not going to go through the details, but hospitality, multifamily housing, retail, student housing, healthcare, hospitals, storage units, industrial office space, things like Amazon warehouses, and then, of course, office. So those are all the different types of sectors, industry groups we could look at in terms of where to put your real estate. And then the way it works, to recap what Greg said earlier, is over time, as you 1031 and 1031 and 1031, however many times you need to do it and continue collecting your cash, watching your portfolios increase in value. Heaven forbid, again, something happens to you too young in life, but eventually we all pass away. And when that happens, that steps up in cost basis, and your kids get all that property tax-free. So basically, it steps up in basis at the date of your death. So whatever the date of your death value is, any growth thereafter would be taxed, but obviously that would be minimal. It'd be negligible. So that's kind of like my take on the different examples I just wanted to share. So sorry for taking up so much time. This is usually me asking questions, but looking ahead, Greg, how do you see the future of 1031s evolving? We talked a little bit on the webinar about regulatory changes and things like that, and I thought the way you put it was pretty funny. So maybe you could just repeat.
Yeah, I mean, I guess you can sum that up because people are constantly reading very dire information that 1031's going away. It's going to be taken out of the tax code because it's a tax break for the super wealthy, and it doesn't need to be there. And that could not be further from the truth. The reality is, major studies have been done. You don't have to take my word for it. They've been done by Ernst & Young, who's done the study twice through the years, and a couple of college professors, Ling and Petrova, out of Syracuse in Florida. And they all found the same thing at both the macro and microeconomic levels, that getting rid of 1031 would bring in less tax revenue for the government. So that's not common sense. You don't maybe understand that at first blush, but the reasoning behind it makes sense. If you take away a seller's ability to sell without getting hammered on the taxes, sellers aren't going to be quick to sell. They'll still sell some properties at some points, right? But they're not going to have the volume that we see today. And properties won't be changing hands. So when properties do change hands, people are getting paid. That's a real estate agent sometimes making a big fat commission. That's a lender getting to make another loan. Construction companies end up doing more work. On and on and on. Attorneys and accountants make more money and so on. Well, they're all paying ordinary income level taxes on that money, which is a higher rate than the capital gain rate. So when they do the studies and actually break all that down, they figure out every time the government will just be giving away billions and billions for no good reason if they try to take 1031 away. And the other thing I mentioned earlier was that the government likes to use 1031s. And what I mean by that is the actual members of Congress who would be voting on this, trust me, they are using 1031 exchanges. All right. We see it nationwide. We've helped quite a few of them across the country to do their own personal or family 1031 exchanges. So they don't want it to go anywhere. So don't expect any major changes to 1031 anytime soon, thankfully.
Yeah. And while we can't name any names, Greg has personally helped representatives of Congress do 1031s. So they definitely don't want it to go away. And I think that's probably one of the things that'll never change, right? Yeah.
We don't expect any changes. But it's a good thing, actually, and they'll keep it going.
Yeah, it's an enormous industry, and there's a lot of players. It's I don't want to say the same reason, but a similar reason why, as much as I would love a flat tax, we'll never see one because there's too many players.
Yeah. I mean, theoretically, if we were starting over, it might be a good idea, but it would truly wreck the American economy if they tried to go to a flat tax.
Yeah, it'd be interesting at the very least, that's for sure. That's our time today. If you'd like to get a hold of Greg, you can find him on LinkedIn, Greg Smith. You can also email him at greg.smith@ipx1031.com. The website is ipx1031.com, and we'll have all the links, email, website, things like that in the show notes below as well. But as always, there's thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for joining us on the Elevate Your Business podcast. To complete our free business valuation quiz, to check out additional articles, webinars, videos, and other educational resources, or to set up an intro call with your host, Adam Koch, just head over to elevateandexit.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for financial advice. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a professional business transition planning consultant or certified exit planning advisor before implementing any of the ideas shared in this episode.